From tech stock euphoria, let's switch now to the bond market. Over the past few weeks, we have seen alarm bells sounding in the world market for government debt. And in some cases, we saw a dramatic surge in long-term yields. In the United States, there's the White House's relentless challenge to Federal Reserve independence. And we have political instability in Europe, especially in France. What is this going to mean for central bank policy, market stability, and the broader economic outlook? We've got more from Lyle Stein, President, Forvest Global Wealth Management. Lyle, great to see you. Thanks for reminding us about this run-up in bond yields. We saw some of them have come down a bit, but there was, over the past few weeks, some selling in global bond markets.
Yeah, good morning, Andy. That's exactly right. The 30-year bond yields around the world were going up really through the course of 2025. Investors are scared of lending money to governments on a long-term basis because they just don't know what that long-term inflation number is going to be. You know, we've sort of got hopes for anchoring it at around the 2 to 3% level. However, when you have all the uncertainties from a geopolitical perspective, as you mentioned, France, to Fed independence, the bond market is getting spooked. And despite the desire to have lower short-term rates, those 30-year rates were rising up until last Friday when the jobs report came out, and that kind of put a little bit more of a fear of a slower economy into the picture.
It is interesting, though, isn't it, that deficit spending, it can't go on forever before the bond vigilantes step in and start demanding spending cuts.
Well, exactly. What was it? James Carville said, I'd like to come back as the bond market. And the bond market will ultimately dictate what that long-term borrowing for governments around the world is going to be, which then percolates into the rates that you and I are going to pay. You know, it's interesting, Andy. It's football weekend. It was the first football weekend. And I was thinking about this question and, you know, Fed independence. Who does the Fed set rates for? You know, is it for the fat cats in the corporate boxes in AT&T Stadium, or is it for the tailgaters in places like Buffalo and Green Bay? They want to set long-term interest rates to keep things stable. It's a midterm to long-term call. But right now, everybody's focusing on those near-term cuts. And the concern that the market has is that if you have rapid declines in near-term interest rates, that could be setting the table for longer-term inflation. And so when you talk about Fed independence and the desire of President Trump to get interest rates down by 3 percentage points, that's where the fear is coming from.
Gold breaking out to new highs. What does that say to you, Lyle?
It's part of that whole uncertainty question. You know, the best chart I saw, Andy, over the course of the last week or two was one that showed gold as a percent of central bank reserves. And it had been falling from 1970. But as of the last 4 or 5 years, it started to move up. The other line on that chart was one that showed central bank holdings of U.S. treasuries. And they have been going up, and up. But over the course of the last 5 years, they're going down, down, down. And what it really looks like is that people are saying, enough U.S. treasuries. We need another asset class to keep in our reserve base. And that's exactly what the market is doing. And that's exactly what investors are doing, is saying, wait a minute, maybe to protect our portfolios better, to protect against a calamity, I have to have some gold in there as a bit of an insurance policy.
Lyle, there's a lot of joy among AI investors today after that forecast from Oracle. But you think that this tech run is showing signs of fatigue?
Well, it is. When you look at the bellwether NVIDIA, it bounces up and down. But the reality is it's got a rolling over pattern. And, at Forvest, we're global investors, and we have to always look at NVIDIA because outside of the UK and Japan, it's the 4th largest market in the world. And, it's just losing its steam. But when you put that in the context of a 30-year interest rate, a 30-year interest rate is a long duration asset. A growth tech stock is a long duration asset. And if long-term interest rates go up, the value of long-term tech stocks with very, very long durations tends to fall, just like the bond price falls when interest rates goes up. So, the question is, why is momentum coming out of tech stocks? And yes, you got a good move in Oracle, and that's great. It's also showing, though, a move away perhaps from chip stocks who are implementing the AI technology for the benefit of their customers.
Just finally, yields high yield stocks have done well for Canadian investors over the years. You reckon with the move up in a lot of pipelines, the salad days of 5% plus yields are behind us?
Yeah, I mean, people are looking for income all the time, and the Canadian equity market in particular generates good yields. But as interest rates have fallen in Canada, those 5% yields that we used to be getting from bank stocks, utility stocks, pipeline stocks have all come down. And the big question that we're asking ourselves, and again, as long-term investors, protecting client money is almost more important than trying to grow it. And in this environment of rising rates, lower bond yields or lower dividend yields just don't give you the kind of returns that you had. And the big question I think investors have got to ask ourselves, particularly in Canada, are rates low because our economy is underperforming, as opposed to just this is a normal time, we're just going to drop rates for the next little while we get through this near-term dislocation.